All right, joining me now to help break all of this down is 32 Advisors CEO Robert Wolf, our very own Kristina Partsinevelos, and Kaltbaum Capital Management President Gary Kaltbaum. Thank you all for being here. Let me start to the right here, Robert Wolf.
Thank you.
Modestly hawkish, I think, is how you'd say it. Everything's on track. They're close to the 2% target rate on inflation. The economy is humming along without going too fast, if you like. This is obviously what the market wanted to hear, and we're seeing all the major markets move higher.
Ashley, I think we could be in all four quadrants, the great, the good, the bad, and the ugly. The great is business investment, I think a 6+ year high.
Right.
The good, earnings, very strong.
Very.
The bad, consumer spending, 5-year low.
Okay, and the ugly?
And the ugly, I would say, starting to talk inflation, going into higher rates. And we have not seen, we haven't seen in years the whole idea of higher rates, inflation, Fed rising. It's been 10 years since we've really seen this type of play and these type of words. So, my view is Fed will probably do more than less this year.
Well, that's interesting because there's no real hint of that, is there, Kristina?
No,
we expect maybe 2 more hikes before
I want
the
to
end of the
just touch on, you're talking about the good for business investment, which it is, but we still don't know where is that money going. Is it going to higher wage growth? And right now, a lot of companies are seeing higher turnover. We have a tight labor market. Yeah. McDonald's giving an example of increasing their wages. So if these companies are increasing salaries, potentially that could trickle into inflation. You have unemployment. 4.1%, quite low. Market where there's not as many job seekers in the market, so that's making it a little bit more difficult. Even, I know that you reported on this yesterday, probably, Hamilton, Ohio, where they're trying to encourage people to move there. Paying there, so they can move there and work there. So business investment, I feel like I want to dig into that number a little bit more.
Very good. Gary Kaltbaum, let me bring you in, Gary. Look, I was looking at your notes. You say, you know what, the Fed doesn't matter as much anymore, which is a good thing, right? We need to get them out of the way, let the market operate as it should, but you still believe the Fed is way behind the curve. How so?
Well, they're telling us everything's just fine and dandy. We're still right at 1.5% Fed funds. We should be 2.5% at this point in time. So they're way behind. But look, let me just say this. The economy's sound. It's nothing fantastic. We can always do better. And it's funny, when there weren't enough jobs, everybody's complaining. And I got news for you. Now it's tough to get a job and everybody's complaining. Excuse me. There's a lot of jobs now. So, you can't get it right. And people are just, they're always looking for the negative. I think everything's okay. Everything's sound. The Fed's behind. They need to do better. The best thing I like is the Fed is now quiet. They don't talk like crazy during the months, driving markets up a wall.
Yeah, we love that. Robert, it's interesting because it's a fine line for the Fed, isn't it? If it needs to raise rates to keep a check of inflation and get us back, frankly, to where we should be, given the economy, but at the same time, they don't want to stamp out that growth.
Yeah. I would agree with Gary. The Fed was too slow. We've spoken about it in the past years. QE3 should have never happened. And so we can't go backwards, but we have to.
Or QE2.
Yeah, well, I'm going for the layup first. So yeah, the Fed's a little behind, no question about it. I think with respect to what Kristina was talking about, yeah, wages are still slow. That being said, average hour work week looks good.
Yeah, that's true.
So there's some things that should push it up, but haven't pushed it up yet. So
you're moving towards the 4 hikes for the year?
I would say, before the last quarter GDP, I would have said the bid offers 4.5. Now after GDP, I'm kind of now I'm like 3-4. But I think if it goes, I'm 3 to 4 hikes. But I think if we go to 4 hikes, we're going to certainly see behind 3, back up, much north of 3%, and I think it's going to have impact on the market.
The 10-year, to your point, has been floating right around at 2.97. Yeah. What's so mystical about this 3% level? Does everything go out the window?
Right? No, well, if you have an
come
inversion,
on, it's 3%.
It's about time. Like you were saying, I think it's time. Our economy is doing better, and like you mentioned, we're never happy with any of the results. There's always something we can pick at, but the talk is this flattening of the yield curve. It could be a good buying opportunity. We haven't hit any type of inversion just yet.
True.
Which is why it's a big media headline.
Yeah.
I'll let Gary talk, but I'll respond to your investment.
All right, go ahead, Gary.
Let's not forget something here. Europe is still negative rates and printing money. Japan is negative rates and printing money. We have easy money around the globe. And this talk of hawkish here at 1.5%, I'm sorry. Hawkish is 4 and 5%.
Right.
These guys are a bunch of doves. And I promise you something. If the markets take a hit or if the economy softens, Powell will lower rates, not raise rates, and if things really worsen, they'll print money again if they have to. They are reactive, not proactive, and again, let's hope things turn out right.
Well, that's a good point, Gary. I mean, what's the chance of them missing the boat on this and inflation getting away from them, and then they're chasing it?
Well, there's certainly a chance, but it doesn't feel that way today. But just to respond to the whole investment philosophy, why does 3% make a difference? Because with the lower rates, everyone was pushed to the stock market.
Yeah.
We were pushed to look for risk assets.
No alternatives.
Okay, no alternatives. Now, all of a sudden, with 3%, you can actually buy, 2-year notes, you know, a lot cheaper.
Get a decent return.
And then with the volatility, you wake up, we're up 400, we're down 400. People are saying, you know what, I'm not sure where we're going. Why not put it back into cash? And you're getting paid a little now to put in cash.
True.
So I would say there's just a new alternative we have not had.
And just to add to that, I think for those that are watching, like, oh my God, Fed talk, I hate that.
Yeah.
We're seeing price increases across a lot of consumer products, and certain companies like the sticky notes from 3M, they said because of oil prices, they have to increase their prices. McDonald's has increased their prices. Chipotle, Whirlpool.
So inflation is coming.
Well, these companies are already saying that they have to increase their prices and have already started to do so.
And let's not forget the worst acting group in the market has been consumer staples because the cost of all that stuff's been going up, food, beverage, tobacco, and all that stuff. So, yeah, there is that definite component. And the one thing we do not want, inflation ever getting out of hand, because once it does, you cannot stop it. The good news is, with rates under 3%, it's telling you it's not getting bad yet, but I promise you, if we break through 3 in earnest and start heading 3.5, 4, Robert's right, the competition for money will be on, and money will leave the stock market and start heading for the income investments again, which hasn't been going on for many years.
Who says that covering the Fed is getting into the weeds, it's dull, it's boring?
No,
you guys did a great job. It's fascinating stuff, even though they didn't do a whole lot. The market up 77 on the Dow. Robert, Kristina, Gary, thank you all very much for pitching in today.